Good afternoon, everyone, and welcome to our webinar, Trading Strategies for Different Market Conditions. Today we have with us Mr. Ishan Gosain from the NCB Merchant Bank, Trinidad and Tobago. He is the Head of Sales, Trading and Investments. Also on this webinar, we have Ms. Kadeen George from TTCD and Ms. Siobhan Harrison from TTSE. So I will hand it over to Mr. Gosain now to start the presentation.
Good afternoon, everyone, and thanks for taking an hour out of your day, especially at lunchtime, to listen to my presentation. And I hope you at least have one big takeaway that will help you in your investing journey. Just in terms of a little background on me, sorry, I've worked about just over 10 years in the investment industry, but more importantly, I would say for this webinar and just in general in terms of trading, I have been personally trading and investing since I started in the industry. So a lot of the things I talk about would be, a lot of personal experience as well. Thing is, when you work for a larger bank or investment house, it's not just yourself, it's, investment committees, board of directors, you have a team. Whereas typically when you're trading, you're on your own. You may have a couple of friends, or family who trade as well, but many times it's yourself, dealing with your own emotions and everything else related to trading. And then one thing I remember hearing when I just started my journey was that top Wall Street traders actually are only right late, like 50-something% of the time, like late 50s. So not that there's no pressure on you, but it just shows you how difficult trading is, which is why I will probably take some time during this webinar to go over, just make sure you're in the right headspace before you begin trading. So I'll just start briefly with the difference between a bull market and a bear market. I will be focusing a lot on the bear market because, that's sort of when your emotions tend to get the better of you, or, it's a lot more difficult to make money, and trading is important. So just to define it quickly, a bear market exists when a broad group of security prices falls persistently for a period of time, a drop of 20% or more in the overall market over 2 months or more, basically. Bear markets occur during economic recessions or depressions when pessimism prevails. Bull market is basically the opposite. It's when security prices persistently rise over a period of time. Again, same, if the market index rises on average of 20% or more over 2 months or more, it tends to indicate a bull market. Bull markets are typically accompanied by periods of economic growth and optimism among investors. So that's just to give you the context, but as I mentioned before, I would like to start with the different biases that, during a bear market you would start to experience. So the two types of biases, cognitive and emotional. Cognitive biases generally involve decision-making based on concepts that may or may not be accurate. So think of it as basically a rule of thumb that you use that may or may not be a fact. Whereas emotional biases typically occur spontaneously based on your personal feelings of the individual at the time the decision is made. They're deeply rooted in personal experiences which influence decision-making. So I'll go into some examples and also give some personal stories. So first one is confirmation bias. This one, you actually experience this outside of investing and trading as well, but it's something that a lot of people suffer from, and it's something that you really need to pay attention to as you're absorbing information. And nowadays with social media and all the different articles, it's very important to keep a check on this one, but let me just give you an example. So let's say you have a view on a stock. So let's say you think Massey is a good buy, and you read two articles or two investment reports from different investment houses that say Massey is not a good buy. It's actually a sell. But then you happen to read or happen to talk to someone and they say, you know what, I think Massey is a buy as well. But you place more weight on that person's opinion who says it's a buy because, you know, they agree with you, basically. So, you know, and you ignore the two investment houses who did, you know, in-depth research and say that Massey's a sell. So you see, you could really get, you know, into a lot of problems with the confirmation bias and, or, you know, not taking in negative news related to your view. Second one is gambler's fallacy. This is like treating the stock market like you're basically playing roulette or, you know, something like that. Basically, it's using data such as, let's say the all TNT index goes up 5 days in a row, and you think, oh, well, that's strange or weird. It must fall the next day. And, you know, you act on that view or that information in terms of selling beforehand or you know, waiting to buy. But the truth is, whatever causes the stock market to either go up or down on that 6th day is not related to the fact that the 5 days before the stock market went up. It will be something completely different. So, you know, you should make decisions based on, you know, loosely related events. Next one is status quo bias. So humans are creatures of habit. So let's say you've made money investing in the banks in the past, although investing in companies you understand is a sound investment strategy, this does hinder you from, for example, let's say TTNGL, when the IPO came out, let's say you were always accustomed to buying Republic, you know, NCB, First Citizens, the bank stocks, and you're comfortable. You might say, you know what, I'll take a pass on that. I don't really want to have to look into energy or what's happening in the energy market or even try to understand it. But you end up limiting your potential profit because NGL ultimately did do extremely well, paid significant dividends over the years. So you would have lost out solely because you're just kind of comfortable with the status quo, which is buying the bank stocks. Next one is risk averse bias. So basically the bull market is alive and well, and many investors would have missed the rally because they keep thinking that, you know, this is going to stop at some point and reverse. But basically, with this bias, people place more weight on bad news than good news. So, you know, for example, let's say, you know, Republic Bank shares were $80 or $90 or when it was, and you know, they have good quarters, great quarters, and then they have one bad quarter, and you say, well, I think it will fall. And basically you end up missing out on the fact that Republic Bank ultimately went up to 140. So you missed out on that gain solely because, you know, you were risk averse and worried. And this bias, which is a cognitive bias, which could be corrected, is very important because basically this bias could cause you to buy stocks when they're high and sell them when they're low, which is exactly the opposite of what you should be doing when you're trading. Because, for example, people with risk aversion bias, many times they would see a stock going up, they'll see a stock going up, and then by the time they finally get in or convince themselves to get in, is literally at its peak, and then they buy, and then a correction comes and the stock goes back down, let's say 20 or 30%, and then they panic and decide to sell because they can't handle the risk or they can't tolerate the risk. But, you know, this could have been avoided with, you know, if you paid attention to this bias. Last one is bandwagon effect. This one, I know Trinidadians use it a lot, but basically, as it pertains to investing, Warren Buffett has a famous saying which says, "Be greedy when others are fearful, and fearful when others are greedy." So basically, I mean, it's related to confirmation bias, but basically investors feel better when you're investing along with the crowd. So you see everybody buying. I mean, there's a bad example with Bitcoin. You jump in, but Warren Buffett's idea, which has proven effective over time, which is take the opposite mentality than the bandwagon effect. And of course, you need to do exhaustive research. You need, not just go against what everyone is saying, because I mean, we can talk about that after, but many times it's more profitable to do your research and take the opposite view. So now move on to emotional biases. So cognitive, the big difference I would say is cognitive biases are more easily correctable because you basically could kind of look for them. You know, it's tangible in the way that you could kind of put things in place to kind of prevent them. But emotional biases are a lot more difficult. It is your emotions. They could run, high or low as the case may be. So basically, cognitive biases could be corrected, but emotional biases are things you need to manage. And I will talk about managing these three emotional biases now, because basically this is what will cause you to lose money. Ultimately, when you're trading, it's your emotions. It's very important to keep your emotions in check. I'll go into a couple personal stories with these biases as well, which hopefully would help you in terms of your own investing and trading. So the first one is loss aversion. This one is actually I would say the biggest one. So I mean, a lot of you have investments. You participate in the stock market. You bought shares through the TTSE, but I'm sure a lot of you all have that one stock that is down significantly since you bought it, and you refuse to sell it because you literally don't want to stomach the loss. That is what loss aversion bias is. In reality, if you sold that stock, you could reinvest the money into a higher quality stock, or a stock with way more growth prospects or a chance of going up, as opposed to that stock that you just don't want to admit defeat and you hold on to. So basically, I mean, my personal story with this is, for example, now this is before NCB bought Guardian with 63% of Guardian. So I had bought both NCB and Guardian shares. This is probably more than 5 years ago, probably closer to 10. And Guardian shares started going down, but my NCB shares were up. So I thought, oh, Guardian's going down. My NCB shares are up. I bought it at $1. It was now $1.40 at the time. Let me sell. Let me take the profits off the table. Let me lock it in. I did well with the 40%. And to anyone who has followed NCB's share price or the market in general, that NCB share price went up to $11 in the following years. So, that's one of my biggest sort of mistakes of not holding on. And it was related to Guardian. The fact that my Guardian shares went down, which at the time were completely unrelated to NCB. So, it was me, with the loss aversion bias, not wanting to, my gain in NCB to go away. So I sold. So, I mean, it's very very common. Even me, that's what experience does teach you, to not make these mistakes again. I do have a solution for the loss aversion bias, and it's something that I learned a few years ago, and it has worked out very well, which is sell your losers and hold your winners. The natural or I mean, everybody's different, but I would say the natural inclination is to do the opposite, which is hold your losers and sell your winners, which is what I did. But the easiest way to correct this bias from an emotional standpoint is whenever you see two stocks, for example, NCB and Guardian, and one is up, one is down, do not hold the loser and sell the winner. Do the opposite. Hold the winner and sell the loser. And I assure you, your gains and your profitability from trading will significantly improve. It's something that has worked for me, a lot since then. Now moving on to overconfidence bias. This one, I mean, it could happen to anyone. It could happen after some early successes, some big successes. Um, you feel like you've done well, or there are a lot of different things that could kind of create this overconfidence bias, but ultimately you believe that you have an edge over everyone else. You have more skills than everyone else. But the truth is probably not true. The market has literally made fools out of the most respected traders. It can do the same to you. I will give another example of this bias in my personal life, which is of overconfidence bias. I don't know how many of you remember when GameStop, it was basically, it was touted on Reddit, a lot of people were buying the shares. I think it started at maybe, I think it was less than $20 a share. And basically it went up to 100 because people were talking in chat rooms, everyone was buying. And when it got to 100, I thought, okay, I'm the smart money, for want of a better word. Let me short GameStop at 100, which I did. And again, if anyone was following what happened to GameStop after, the share price actually went to very close to 400, if I'm not mistaken. So if you do the math, I will go into shorting a little bit later, but basically at 100, let's say it was 400, my loss would have been $300 per share, which is even more than the $100 that I shorted. So it was a significant loss. I didn't sell at that point, but I'm just showing you what overconfidence could cause. When you think you know the market better than everyone else. But the truth is, the market is the market. It's people just like you and me. Everyone has emotions. There's a lot of psychology in it. Even if you think you are right, based on all the analysis, markets overshoot both ways, down and up. And in that case, it overshot. But luckily for me, I was able to hold on long enough. But depending on the size of your portfolio, and I will go into that shortly, but I was able to manage the risk or the loss, but that isn't always the case. So there's something to keep in mind at all times. Last one is endowment bias. It's similar to loss aversion, but basically, for example, it's basically what you own, you think of it as more valuable than what you don't own. So for example, let's say you own one bank stock, all the other bank stocks look better, but you say this bank is the best in the sector. I am happy with this bank, but you're basically losing opportunities. That's an emotional connection to that bank of you thinking it's the best, as opposed to, let's say, the facts of this bank is growing more or paying higher dividends or whatever the case may be. So that's another one to look out for. So I'll just move on to ways to profit in bear markets. The truth is that there are always opportunities to make money. So I did briefly mention the short position, but I'll just explain what exactly a short position is. Now, this isn't currently available in the local market, but I do expect that, as we grow and develop our financial and capital markets, it will be an option. So basically, a short position is when you borrow shares that are not yours and you sell them in anticipation of the stock price falling in the future. Basically, if this assuming it's a profitable trade, when the share price drops, you basically can buy the shares at a lower price, and you essentially give back the shares to the person or institution you borrowed from. So you make a profit on the difference, basically. Put options, it's somewhat similar, but basically it's an option, so you don't have to execute it. It's a lot cheaper too. You pay a small premium as opposed to actually buying the share or shorting the share. But basically, it gives you the right or option to sell a stock at a particular price. So let's say, for example, a stock is $10. You may buy a put option at $8. So let's say the price drops below $8, you still have the ability to sell at $8. So let's say it drops to $6, you would make that difference between $6 and $8, which is $2. The last way to, I guess, profit in bear markets too is short. Well, one of the last ways is short ETFs, also called inverse ETFs. Basically, now you can buy an exchange traded fund, which is essentially a traded mutual fund. The one ETF that I would say that we have in Trinidad is the UTC Macro Index Fund, which is traded on the Trinidad and Tobago Stock Exchange. It is not an inverse ETF, but it is an ETF. But basically, a short ETF of that, for example, would be, let's say the Trinidad and Tobago market goes down 10%, a short ETF would actually go up 10%. So it does the shorting for you, but you just buy it like a normal mutual fund or ETF like the Calypso fund, and it goes up. So that could also be something to consider when the market is going down. There are also a lot of defensive strategies, hedging, short selling, and protective puts. I would have spoken about short selling already. Protective puts, all that means is that let's say you own a share, you also buy a put option on that share. So if it does drop, you are protected from on the downside. So, you don't take the full hit in the price of your shares, but you actually, make some profits, some of it back because of the put option. A big thing for Trinidad and Trinidad's market, as well as the Caribbean market, is value investing. Now, the good thing about bear markets, and it goes back to what Warren Buffett said, is when others are fearful, be greedy. There are many stocks that, let's say, certain investment houses may do valuations of, or you may do your own research and say, you know what, I think this stock is worth $100, let's say. But you know what, right now it's trading at 110. The good thing about bear markets are the whole market typically goes down together. So, for example, you may have done a valuation at $100 and all of a sudden you could buy the share at $80, which is great. So, when the market does recover, you will get, $100 or more. So it's really a good time to look for value, and there is a lot of value. The one thing to be careful of are value traps where companies' prospects, like their future growth prospects, are not great. In that case, the value, it's not like when things turn around, they will turn around. They actually wouldn't. They're actually on a downward trend. So another way of making money in a bear market, and it is related to value investing, is actually IPOs. So, I mean, unfortunately, we haven't had the number of IPOs that we would like yet. But it is something that personally I work on, and I do expect that we will get a lot more between over the next few years. And this could be a very good option for you with your TT dollars, because the thing is about IPOs is IPOs are always priced below what they're actually worth. So, it's almost like a value play because brokers do sell pricey shares at a discount to encourage trading. So you typically get, a 20 or 30% pop in the price when you buy an IPO. And this would happen even if even in a bear market, even if there was, a recession or COVID or something bad was happening in the market, IPOs would always be sold at a discount. So you will be able to make a gain, a quick short-term gain based on just the price you buy in and the price that it will ultimately settle at. I mean, there are other options like dividend investing, so where you focus on stable income generating stocks. So, for example, in Trinidad market, there are plenty, the banks, some of the conglomerates, etc., all pay stable income, dividends, basically. So even if the price is falling temporarily, at least you get dividends, you get some sort of return. You could use the dividends to reinvest into more shares that you would be basically essentially buying at a discount. So, that could be one option when the markets are down. You kind of focus on income, and that can be, got from many companies listed on the Trinidad and Tobago Stock Exchange. The last point is reducing your exposure. So this would be based on your risk tolerance. So for example, some people really can't handle too much volatility in their portfolio. And this could be for a lot of, many different reasons. It could be their age, where they are in their career, etc. So for example, if there's a bear market and it's affecting your portfolio too much in terms of your comfort, you could always reallocate, for example, to more stable investments such as fixed deposits, repurchase agreements. You could buy bonds, short-term bonds. So you could diversify your portfolio more, so it doesn't just take some price hits because of the fact that the overall market is down. I just included a couple other things here. We'll have to have a whole second session on, I guess, trading 202. This is more the 101 class, but basically there are other options which people do make money from, but again, it's important to make sure your mind is sound in terms of your biases and emotions before entering into any of these swing trading, technical analysis, again, very detailed, trend following, contrarian investing. Contrarian investing is somewhat related to the Warren Buffett statement, which is, everyone is doing X, you do Y instead. It has turned out to be profitable at times for many people. Last part, but very important part is the risk management. And ultimately, I mean, the slogan is plan the trade and trade the plan. It's very important to practice proper risk management in volatile market conditions. It will literally cut down your losses. It could protect you from losing all your money, for example, in trading. So is essential. It is often overlooked, but if you really want to actively trade, you really need to have a proper plan, because you could be doing extremely well for a long period of time, and in one or two bad trades without a proper risk management strategy, you will take significant losses. So just a couple little suggestions here to help you with your trading and a plan. There's something called a stop loss, which is basically, let's say you buy a share at $10 and you put a stop loss at, let's say, 7. So if the stock price drops to 7, your shares are sold. So basically, it mitigates the risk of the stock going, for example, to 0. The take profit is the opposite. So let's say you put a take profit price of, let's say, 14 in the same example of the share price being 10. When it hits 14, the shares are sold, the profit is locked in. So if it drops after that, you would have already had your profits booked. there's another thing called the 1% rule, and this is especially important for active trading. So basically, this is, you should never put more than 1% of your capital into a single trade. Now, I would say with our local market, you could definitely go more than 1%, because of the fact that there's less volatility in our market than some of the international markets. So, I could feel comfortable by, letting you put 5 or 10% as the case may be, depending on the stock. Of course, it makes sense to talk to a professional and, bounce ideas off of them. But still, part of your plan should always be, never put more than, let's say, 5% of your portfolio in one trade. Trading is one of those things where, it could be a day, a month, a year. It really depends on the time. So it also depends on your time horizon for the trade too, how much percent of your portfolio you would actually put into. So yeah, I spoke a lot about bear markets. So I just thought I'd briefly mention bull markets. Obviously, if everything is going up, you can just simply buy the shares and hold. You will make money. You also buy call options, which is the opposite of a put, where you have the right to buy a stock at a particular price. So, as the share prices go up, so does the value of the call option. A long ETF is actually like the Calypso UTC macro index fund, which basically tracks the local stocks. So, if you expect the market to go up and continue going up, you can buy an ETF, and you will benefit from the rise in prices. So, that's basically it from me. I will take questions, but just to sort of go back, in concluding, I would say the three most important points are to eliminate your cognitive biases. It is difficult, but once you take your time, slowly but surely, you will get rid of all. The second one is to manage your emotional biases, especially loss aversion, which is, and my advice was sell the losers and hold the winners, not the opposite. And the last, I guess, piece of advice was plan the trade and trade the plan, which is very important with things like stop loss and percentage of your portfolio that you do plan to invest in a particular trade. So thank you very much for listening, and I look forward to your questions.
Hi, so I'll read out the questions for you, Ishan.
Sure. Yeah, I actually see them too. So I could just start if you want.
Sure, that's fine. That's fine.
Sure. So yeah, the first question, is there a difference between investing and trading? That is a good question. Short answer is yes, because trading typically is more short term, whereas investing, I would say, is long term. So I would define investing as, you basically, the goal of investing is to keep accumulating, you keep buying, and you never really sell. The thing about every investment portfolio should have a trading component where, you buy and sell, you take profits, and you do a lot of the things I was talking about. Investing money you kind of don't touch, but trading is important to be active. You could, buy IPOs temporarily, sell, get into another one, etc. So, all right, next question. What platform do you use to buy and trade international stocks from Trinidad? All the brokers have different variant platforms. There's a cheap one. There's some of the cheaper discount brokers where you could actually open an account directly, like Interactive Brokers as an example. Yeah, I would say. Another one, I purchased some IPOs recently and haven't done anything since. What advice can you give me for me to enter into trading? So this one, so IPOs, as I mentioned, are a great time to start investing. But the other thing is, a lot of the investment houses, including us, would put out by recommendation. So I would say that would be our starting point in terms of, what to buy or to actually trade. Like listen to the experts to at least start, and you could also do your own research and educate yourself as well. So you don't have to solely rely on what the particular broker is saying. So this is a good question. Do you have a time horizon to decide whether a stock is a loser or has a temporary setback and expects to go back up? This is a difficult one because every stock would be different. But this is where something like a stop loss would actually help, So, I mean, outside of the fundamental, what is happening fundamentally with the company, you could use, it's hard to use a blanket number, but let's say you could use 20 or 30% as a stop loss, to prevent further losses. Whatever time period that happens over, I would say is more important about the loss than the actual time period. Somebody said, can day traders make profitable income? This one is a difficult one for me to answer because to me, if this is my personal view, if you were only trading, like let's say not you don't have a job and just purely trading, I think you would need significant capital to be able to do so. So I would say, it's not like you wouldn't make money. You need to follow all the rules, and you will make money. But I mean, to do it daily, I do think it's difficult. This is a good one too. The US is in a rising interest rate environment. However, we have not seen the same trend in our market. How do local investors benefit from the US rising interest rate environment in Trinidad? I mean, this is a difficult one. Well, actually, it's in TT dollars. So unfortunately, unless you're able to convert your currency, it would be difficult to take advantage. At some point, interest rates will have to rise in Trinidad. I'm not saying that would happen very soon, given the latest central bank monetary policy report. But it again, very good question. Somebody asked what was the performance of a unit trust ETF. So as far as I know, the price is probably a little bit down from where it originally started, but they have been paying consistent dividends. The other thing is the traded price is different from the net asset value, which is what the shares are actually worth. So my understanding is that there's a big discount in the ETF. So for example, I'm not saying this is a buy for sure, but I mean, if you do buy it and you hold it for the next, I think 2 to 3 years, you will make a gain because of the difference in NAV versus the traded price right now. Somebody asked if these strategies could be done via top. So most of the, well, I wouldn't say most. I would say it depends. So short answer is yes. But the other thing is, for anything too I guess fancy, and I'm assuming top would introduce more features as well. Some of the things you may have to go through your brokers, but your brokers will be able to advise you as to depending on the strategy that you want to implement. Can you speak a bit on margins? I didn't actually speak at all on margins, but you could. I know some of the brokers allow you to borrow against your shares, for example, and then use those funds to invest in more shares. that could be a strategy too. But again, careful and practice proper risk management if you're using leverage. So how much is necessary to start trading an investment in the stock market? I know our minimum is 2,500 TT. So, I mean, other brokers may be a bit higher, but I mean, it's not, too prohibitive. I currently use Interactive to trade and the researcher excellent. Do you think we'll get an equivalent for our local TT market? What I would say is Top has changed the game quite a lot in terms of an individual being able to participate. And just for those of you who don't know, Top is the trading platform, online trading platform that was created by the Trinidad and Tobago Stock Exchange to allow you to participate. So what I would say is it does change the game in terms of, you don't need to call your broker, make sure they and give them a price and all of that. You literally enter your trade. So we are digitizing our stock market. So I mean, what I would say is we're on the right track. So someone asked if there's anywhere to get accurate data for local stocks. What I would say is the stock exchange website does have a lot of real-time data in terms of all locally listed stocks. So I would say if there's anything you need specifically, you could probably reach out to the stock exchange, and I'm sure they will provide the information. But a lot of it is on the website. Somebody asked if it's possible to buy US stocks from Trinidad without the use of a broker. No, I don't believe you could do it without using a broker. Somebody asked about if Trinidad has index funds and if they're a good investment. So Trinidad, as I mentioned, has the UTC macro index fund, but also mutual funds are like ETFs, right? So, I mean, they invest in a basket of investments, stocks, bonds, fixed deposits, etc. So I would say you could kind of go with a mutual fund as well. That kind of limits your risk because, for example, if you're now starting out, you don't want to put all your eggs in one basket, for example. You do get quite a nice diversified pool of assets via mutual funds. Someone asked how does one go about setting up the platform to begin retail trading? So what I would say is you can call any of the registered brokers with the Trinidad Stock Exchange. NTB is one, and we will walk you through it in terms of once you open an account, one of the forms is setting up a top account, and then we'll kind of guide you in terms of what to do and how to do it. Somebody asked if the unit trust ETF is a better investment than the TT income fund. What I would say is a completely different risk profile. So for example, the ETF is actually mostly local shares and also some international oil and gas companies, whereas the TT income fund, so that could obviously go up and down. Whereas the TT income fund pays, I believe, maybe like 1.5%, but your investment doesn't fluctuate. So you're guaranteed 1.5%. So it's completely different risk profiles. So very difficult to compare. But yeah, hopefully that answers your question.
So that brings us to the end of the Q&A segment. I would like to thank Mr. Ishan Gosain from NCB for hosting this webinar with us, and also our representatives from TTSE and TTCD, Katie, Siobhan, and Nicola. We thank you, and we thank everyone for attending. Have a good afternoon.
Thanks a lot. Take care.